Inflation has come down to its lowest level in more than a year. Inflation, of course, records the rate at which prices are increasing, and it's been a concern because it's been well above the Reserve Bank's targeted ceiling of 6% for some time. Now, that has led to the bank raising interest rates in an attempt to cool inflation. At 6.3%, the inflation number in May is still above that ceiling, but it has come down for a second consecutive month after hitting 6.8% in April. And this is the lowest since April of 2022, when the rate was 5.9%. Now, let's look at the details. Most food and non-alcoholic beverages recorded lower annual inflation rates in May, with the exception of sugar and sweets and desserts. Food inflation was lower at 11.8% when compared to the April reading of nearly 14%. Fuel price inflation also looking better for struggling motorists. In May, prices of both grades of petrol did increase, though, by 37 cents per litre. Diesel came down by 74 cents per litre. Now, the reading of 6.3 is an annual inflation comparison, while the consumer price index increased by 0.2% if we look at it month on month in May. Well, to discuss, we're now joined by the Chief Economist at Old Mutual Investment Group, Johann Els. Mr. Els, thank you for being with us. So it's not only the best in 12, 13 months, but it's lower than expectations. Is it time to pop some champagne yet?
Not quite yet, but at least we've started on a more firmer downtrend here. It's been expected for some time, but because of load shedding issues that caused food prices to remain higher for longer, we've been waiting for this point where we can say now, in earnest, food inflation is heading lower, and that will help headline inflation to head lower soon. So last May, as you rightly said, we had some pretty hefty price increases in the month of May 2022 on the back of that war in the Ukraine that caused grain prices and edible oil prices to rise quite significantly. And so now just lower price increases, and in many instances within the food components, also price decreases in the month of May this year. So the year-on-year numbers coming down quite nicely. So very good news indeed.
Let's focus on food specifically, because we know that food inflation really hits the poor, who spend a larger portion of their salaries on food. It was still 11.8%, which doesn't sound great, but like you say, some significant decreases. So will that be sustainable? Can you answer that?
Yes, I think so, because if we look at the pipeline prices, in terms of prices on the grain markets, for maize and wheat specifically, but also in the producer price area from agriculture right through to manufactured producer prices within the specific food components. All of those in the pipeline have eased off quite significantly. So the next step is for those decreases that we've seen to come through on the consumer side as well. So I think consumer food inflation will head down further over the next few months. And in terms of the numbers, as I look at it, could easily be around 6% on a year-on-year percentage change basis by the end of the year. So while that still means food prices are rising at a rate of 6% by the end of this year, it's still a significantly lower increase than what we've become used to over the past year or so.
All right, then the big question, what does this mean for interest rates? We've been tracking the suffering of people with car loans, with bonds that have gone up by more than 30% in terms of payments.
Yes, absolutely. So the news is that interest rates probably won't go down pretty soon, but because of that lower inflation number, plus also the expectation of lower food inflation and thus lower headline inflation over the next few months, in terms of my forecast, in headline CPI inflation can be below 6% by June and below 5% by July, and around 4.5% for the rest of the year. So that means it's unlikely that the Reserve Bank can hike rates any further this year. So in terms of my forecast, looking at these numbers, what comes through the pipeline, etc., and the lagged effect of past rate increases on the economy, we've seen the last rate hike by the Reserve Bank in May.
Okay.
So no further rate hikes, but unfortunately, we still have to wait a while before we see any rate decreases.
How long could we see it at the beginning of next year, middle of next year?
I think the fact that the Reserve Bank has been fairly aggressive in March and May this year, and I think there's a very good opportunity for price increases or inflation to surprise us on the downside, as we've seen in many other countries over the last couple of months, that there is an opportunity for the Reserve Bank to even cut rates by the end of this year. But let's say around the end of this year, beginning of next year. I don't think we'll have to wait until the middle of next year, because inflation around 4.5% late this year, a very weak economy. The Reserve Bank is well aware that a weak economy, suffering consumers, will likely help to keep inflation low. And therefore, we probably need to see rates starting to decrease pretty soon.
Okay, that certainly is good news. I guess it depends on what the rand does. International oil prices affecting fuel. We're still part of this global system where it seems anything can happen.
Absolutely. So the rand is a crucial aspect there. And for the Reserve Bank, that weaker rand and the potential impact that might have had on you and me in terms of inflation expectations. We walk into the shop, we expect higher prices, we accept and we pay. And that's the risk of the rand. But I think the rand has come back from those extreme levels that we've seen over the last month or so. And if the rand holds fairly more stable levels and international oil prices, as you rightly say, maybe things are starting to get aligned to get inflation lower and thus less concerned by the Reserve Bank about a weak currency.
Well, let's look at the rand. I mean, it actually strengthened slightly after losing more than 1% yesterday. And those higher interest rates are generally good for the rand, right? So what do you see in terms of the currency going forward? At least if we start cutting rates, that'll be in tandem with the world, I guess.
Yes, and I think still, despite our concerns about local issues like load shedding and politics and policy and growth, etc., the bulk of the rand's value is determined by global factors. Over the past year, because the US Fed has hiked interest rates, the US dollar has been very strong. And then every time there's some concern in the US about further rate increases, dollar strengthens, rand weakens. Now that the Fed has paused and likely, in my mind, have stopped the rate hiking cycle, and markets are going to start to look forward to rate cuts in the USA late this year, perhaps, but perhaps even more early next year. But because markets look forward, I think we've seen the bulk of the strength in the US dollar. The dollar can drift further, and that will likely help emerging market currencies and the rand. And the rand has been extremely oversold, and that usually means it comes back a little bit. Less load shedding will help. So my view is that the rand's weakness that has been overdone, we're getting back to a slightly stronger rand by the end of this year into early next year. It's certainly not going to come back to sustain stronger levels, but because it's been so weak, the rand can easily come back towards 17, perhaps even 16 something by late this year. And that will certainly be positive in terms of the outlook for inflation and thus interest rates.
Yeah, of course, everything that we import then is a relatively better value. Finally, are there any big trends here that you're seeing in the numbers? I mean, something stood out for me, Stats SA, saying that dining out is popular again, especially during load shedding. So despite the budgets being constrained, people are making a plan. And it's interesting how those two economic phenomena are linked.
Yes, so it's this difficulty. We are under pressure because of price increases and electricity price increases, stuff that has hurt consumers significantly, interest rates as well. But underlying consumers have still got a bit of a pent-up savings that they can spend. So the underlying balance sheet of consumers have still been fairly healthy compared to pre-COVID. During COVID, we didn't spend as much as we used to, so there's still a buffer that will help consumers. There's some underlying improvement in employment, not fantastic, but still positive. That helps consumers. And consumer confidence survey shows us that at least the lower income groups are fairly okay with their household financial position. And there, of course, social grants and COVID grants, etc., helps. So certainly there's that ability to spend still better than what we feared at the start of this year.
All right. Well, quite a few nuggets of good news there. Thank you so much for your time, Johann Els from Old Mutual Investment Group, talking about inflation looking better than it has in a year.